Can I invite everybody to please take their seats so we can start the session? Thank you. Right, I've got a clock in front of me that's counting down. So I need people to sit down, please, so we can get started. Thank you. Right, first of all, thank you very much for coming to the session. As you can tell, this is a large room to fill, so I'm very glad to see you turn up in numbers. So this session is titled The Legal Status of Carbon Credits, How the Financial Regulators May Shape the Market. And I think it's worth, therefore, me spending a little bit of time explaining what we're going to cover and therefore what we're also not going to cover. So let me start by saying that if somebody came up to a lawyer and asked what exactly is a carbon credit, our heads as lawyers immediately turn to a certain question, which is it a property right? Is it a personal right? And the reason why we ask those questions is because we're immediately thinking how we're going to finance the investment in this. So knowing what type of asset class it is and how it is legally classified is helpful to working out how you can apply financing techniques to invest in the asset, right? So that's why we ask that question. But just to be clear, that is not what this session is all about. This session is about how, from a regulator's perspective, they should view carbon as an asset class. So for example, if you treat it as a financial instrument, people who engage with carbon credits will have to think of it and deal with it in a certain way because there'll be a financial regulatory framework that sits behind that classification. If, on the other hand, it's treated as a commodity, then from a jurisdiction to jurisdiction basis, it'll either be a regulated product or an unregulated product, and consequences follow from that. So the theme of this session is really to talk about how should a regulator view carbon as an asset class. And of course, the context here is that in the carbon markets that exist today, we have a two-pronged approach. We have the Article 6 markets under the Paris Agreement, which are, as you've been hearing about throughout the conference, up and coming and new, and are being built as we speak. And then you have the voluntary market, which has been around for a number of years, but has suddenly, in more recent times, gained a lot of traction and attention. So when we talk about things during the course of this session, please bear in mind that there is a compliance market and there's a voluntary market, and that distinction will be important in the way in which we talk about the application of regulation to each of those markets. So with that brief introduction, let me introduce very briefly my panel. To my right is Sandeep Roy Chaudhary. Sandeep is the co-founder and director of V&V Advisory, and I know has been in the carbon market at least as long as I have. So looking forward to getting his input on things. Online but not present, we have Belinda Ellington, who is the general counsel of the Global Commodities team at Citibank, and is also the co-chair of the IETA Legal Working Group. To my far left is Thomas McMahon, who is both the CEO and co-founder of Air Carbon, a platform that has homes here in Singapore and also some new homes in Abu Dhabi, which I'm sure we'll get into in the course of our conversation. To my right is Mike Kierstead. Mike is head of environmental products at ICE, the exchange, and has come a long way from Calgary, right, to be with us today. And it's his first time in Singapore, so we're hoping that you guys give him a good experience from being on the panel here today. Last but not least, to my left is Professor Hao Liang, who is a professor at Singapore Management University. And I'm going to start with a little anecdote. I'm not going to call him Prof. Liang, which is a local practice which I really get irritated by because you've earned the designation of professor, so I'm going to call you Professor Liang. Right. With that round of introductions, let me kick it off by first asking Sandeep to give me his perspective. So Sandeep, your role as a developer of projects and advisors to governments and authorities around how carbon markets can and should operate allows you to speak to people in different spectrums, including at the origination end of the market, right? And from the conversations we've had, we know that people are struggling to work out what to do with carbon as an asset class, right? Should they regulate it? Should it not regulate it? Looking at it from your perspective of the type of work you do at the primary market end, do you want carbon to be a regulated asset? And if so, why? If you don't want it to be a regulated asset, also why? One thing that does often follow is if it is a regulated asset, the people who deal in it often land up being regulated. So I think I might know what the answer to my question is going to be, but let's hear it from you.
Thanks. I think from a project development perspective, and like you mentioned, we've been here for years now, without regulation to a large extent. And I think if we're looking for scale, and carbon credits, like Peter said, we have the compliance and the voluntary markets. Whatever we do with regulation, what we cannot afford to do is stop action. So what we need to understand is we can never have perfect in the way of good in terms of regulation. We are in a situation which is urgent. It's action that we probably needed yesterday. So whatever we do, and this is across the board for all kinds of regulations, I know this is titled financial regulation, there will be governance regulation and a whole host of other kinds of regulations. Whatever we do, we should not lose sight of the end game here, which is action on the ground. So now, having said that, when we move into areas a little bit more layered approach, I think the compliance/voluntary, the lines are getting blurred already. So there is going to be some form of regulation, and I actually personally look at it as a soft regulation, and then there is a hard regulation, which is typically a compliance from a government. It could be taxation, carbon pricing, and so on and so forth. And then there's a soft regulation, which is guidance at the corporate side and the buy side. I actually do think there should be some form of regulation even in the VCM, even on the supply side, because the integrity of the supply side is really, really important for the markets to survive in the long run. So there has to be some form of regulation. I'm not a big fan of governments coming in because a lot of governments that we work with don't really understand carbon credits. And for me, how we look at it is like, guys, we can do both. You can have compliance, you can have voluntary. Let voluntary do its thing, because the voluntary market is doing things which governments don't necessarily have done or can do, for that matter. So in my opinion, we layer it into about 3 or 4 buckets for governments, where we say, okay, there is a high bucket, let's look at Article 6, 6.2, 6.4 mechanisms, this is your high-hanging fruit. There are credits which are not in demand in VCM at all. Make them into a domestic market tool. Look at the credits that do have a VCM demand, and then look at how you want to adjust, not adjust, and see how you want to have an interplay over there with the VCM. So there are 3 buckets that you generally would want to put your credits into as a carbon credit, and then work your way around it. I think that's really important because a lot of people are getting very confused with the amount of terms of carbon credits. This is an asset class at the end of the day. I define it as a commodity. I know there's lots of lawyers in this room who might have their own definition of it. For me, it's just a commodity at the end of the day. And we believe that there's just so many terms of, we have ITMOs, we have VRs, we have authorized credits, unauthorized credits. It's a mess. Either we have adjusted credit or we don't have an adjusted credit. I think we should just live with those 2 denominations as far as I'm concerned, because it makes it simpler to understand. And I think that's where, on the supply side, I do think there should be, now this could be self-regulation or a body that regulates this to some extent, because otherwise the supply side is going to run away with absolutely raw credits, and this is actually going to be detrimental for the market at large. I do believe there should be some soft regulation on that end. In a nutshell, I think VCM should fairly be unregulated because it is voluntary at the end of the day. Keep it voluntary instead of messing around with that, thinking that this could be a compliance thing. It is not. And yes, voluntary credits could be used for compliance, and as and when that happens, the compliance rules will kick in and probably proceed or take it at a higher level in terms of how the law comes in. But in a sense, I would implore everybody that, guys, at the end of the day, we need these projects on the ground, and we cannot afford to make regulations which are detrimental for these projects to happen. Case in point, governments restricting carbon credits from being exported into countries. That's misinformation to a large extent. There's no reason why that should happen. So now that misinformation has happened because there's just too many conversations going on in terms of the legality of NDCs, of adjustments, of credits, et cetera, et cetera. So that's where to simplify it a little bit, let's not, have knee-jerk reactions on regulations. Financial regulations will kick in on the buy side. It is already helping to pick up demand, actually, because the ESG regulations on the buy side is making a lot more people buy offsets than they used to earlier. So I think that's a good thing. But on the supply side, I think keep it largely unregulated, but always keep an eye out on and this is probably going to be, with the ICVCMs and the works, going to have some form of regulation, which I actually think is quite necessary as well. So I'll stop.
Thanks, Sandeep. I want to make sure everybody on the panel has a chance to say a few things, but we're going to come round and hopefully do a proper Q&A session after the first round of discussion. So I'm going to turn to Belinda now. So Belinda, Sandeep already has suggested that he thinks that a carbon credit is a commodity. I know from our previous conversations you feel the same way. But we both will remember that in the compliance EU ETS market, many, many years ago, there was no attempt to try and classify an EU allowance as a financial instrument. And it eventually got classified as a financial instrument as a reaction to things like VAT fraud and stolen allowances and the hacking of the carbon allowances from the local national registries. And the driver for therefore making a carbon a financial instrument at that point was a fast-track method of ensuring KYC to keep out bad actors. Now, as a consequence of course, the introduction of EU allowances as a financial instrument, only compliance entities or a financially regulated or licensed entity is able to actually deal in derivatives, not spot, but derivatives of carbon allowances. So recognizing that that happened in the EU allowance market at a certain level of its maturity, it strikes me that there's a point in time where you should think about regulation, and there's a point in time you should let the market just grow and mature. But of course, you as a financial institution who want to get involved in products like this may have a very, very different perspective. So Belinda, over to you to walk us through how Citibank or a bank in a similar position to Citibank might wish to address the question of the regulatory status of carbon credits.
Thank you, Peter. You paint a bleak picture of the EU ETS. You'll scare everybody off. First of all, just to sort of define some of the parameters, I like to talk about verified carbon credits rather than the voluntary carbon credits, because really what we're talking about are project-based carbon units as opposed to government-issued sort of permits to pollute. Some of those carbon credits issued from projects may be destined for the voluntary market, i.e. they just may be purchased voluntarily. Some of them may be purchased for compliance purposes. We don't know where those may be, but it is up to the national governments and their ETSs, their emissions trading scheme, to determine whether they're going to accept project-based carbon credits into those systems. So, as Sandeep said, the critical issue here is we're talking about the voluntary carbon market. So people who are purchasing credits completely off their own initiative. So when we talk about regulation, again, let's define what we mean by regulation and what it's for. Sandeep referred to sort of regulation, which is at the buy side. Now that's a very different kind of regulation, I think. That's about regulatory obligations to potentially buy certain types of units or credits, offset an obligation to meet a net zero target. I think what we're talking about here is regulatory oversight of a market. And that's oversight of the production of the unit and then oversight of the players within that market. And I agree that there needs to be some kind of oversight. The question is who should perform that oversight? When we talk about regulation, we tend to think about the sort of prudential regulatory bodies. Now, I don't think that is necessarily the right way to look at this for the voluntary carbon market. but it doesn't mean there shouldn't be any kind of market oversight. It's correct. I think that treating voluntary carbon credits like a commodity would facilitate the fungibility of those assets. And that's what we really need if you want to create a market. You need to be able to create an asset that can be transferred easily between parties. And again, let's look at what that actually means. This carbon unit doesn't actually travel between one country and the other. It sits on a registry. It's the parties who are participating who enter into cross-border transactions. So it's the oversight of those parties. Now, as a bank, we have oversight. Everything that we do is regulated. Does the instrument need to be regulated as well? Not necessarily, I don't think. I think it could create a barrier to the liquidity in that market. For an institution that is trying to help facilitate this market, let's look at what we do. At the source end, we finance the projects, and that can be through sort of prepay, but essentially sort of offtake agreements. Then we provide market access, so enabling, we sort of match up, provide liquidity in the market, and we provide price management. So if we have a look at how those markets can be regulated, if you like, what kind of oversight is appropriate? Well, at the production end, very much like commodities, it's about determining the quality and the parameters of what that item actually is. And we have some very good oversight. We've got standards. So we've got there are some the standards that actually register and produce those carbon units have particular parameters around what they will produce and what they won't produce. So it's about having accreditation of the production side rather than a sort of regulatory definition of what that instrument is. And then oversight of the market players is about KYC and about dealing again with accredited institutions. So you have to create a market that people feel safe in order to create a liquidity within that market. And that's about creating high enough walls around the production of the item and the participants within that to enable people to feel safe and also to create a fungible market. So do I think that they should be classified as financial instruments? Well, I think the problem with that is that you're creating a definition which is bounded by the walls of the country in which those regulations are sitting. And that creates a different treatment from one jurisdiction to another and could potentially, I suppose, stymie the liquidity of that market. And in the voluntary carbon market, what we're trying to do is build liquidity. We're trying to build a brand new market. So what is important is to create confidence within that market and high enough walls, but not necessarily a complete regulatory oversight in the prudential concept.
Thanks, Belinda. My takeaway from that is we've got to be careful how we strike a right balance. Tom, on the subject of striking balances, so you've helped set up the Air Carbon Exchange in Singapore. And I know from your experiences, one of the big questions that you had in the process of setting up was, how does Singapore treat carbon as an asset? And I think the answer, and you can please correct me if I'm wrong, is that they don't treat it like a commodity. And at the same time, it's not a regulated instrument under the Securities and Futures Act at the moment, and therefore it's not a financial instrument either. So that puts you in a position of slight limbo, perhaps. You've since set up a regulated exchange in Abu Dhabi. Can you talk us through the pros and cons of clarity of regulation or lack of clarity of regulation and how that influences the way you look at your business opportunities and the way in which you structured your exchange?
Thank you. Yeah, and Peter, you're correct. I'm a commodity guy. I spent 20 years on the trading floors in New York and began in the ags markets, went into the energy markets as the global benchmarks emerged. So I've got a long history, and I was on the board of directors at NYBOT and NYMEX and learned how to do, I mean, in those days, it was the members of the exchanges actually built the products and then traded them in the pits, and you'd appreciate this, Mike. That world has changed now. We're all electronified, and that whole incubator effect is gone. So you're dependent on regulation and frameworks and market adoption. When I looked at carbon, I had traded carbon under the EU protocols back in '05. I traded EUAs, and it was a great market. It sat alongside the other energy baskets that I was transacting, and especially against gas and power. And then the market died in 2012. No Kyoto 2. And then in 2015, we had the Paris signings, and I started to pay attention again. And the difference that I saw was it wasn't really the 47 countries under Kyoto and UN, it was 196 countries. So you couldn't export dirty industries, and the borders went up, and the responsibility. Now, we're 7 going 8 years on from that. The difference is, A, awareness, B, the ability or the demand for finance. I started to look at, and then I looked at aviation, which was that first standard, the CORSIA compliance under ICAO. And if you look at that, it looks just like a commodity framework for a contract on an exchange. It's a one-pager. We used to call them dummy pages. You know, if you want to look at a contract on an exchange, there's like 90 pages, but you really want to look at it, it's one page. It gives you the specs, what's considered good delivery. And ICAO defined that under aviation, and voluntary carbon credits could fulfill that role of demand. So I started to look at that and go, hey, that's a benchmark in the making. Right? Could that be adopted to an exchange markets architecture? The answer is yes, and it's not just us. There's other entities trading CORSIA structures. Then I approached the regulators, and I said, hey, here's an idea. The idea was to adapt the best market practices around commodity markets architecture, but the best attributes of a digital markets architecture, blockchain, distributed ledger, asset-backed tokenization, custody, and such. And the logic is because carbon credits are digital by nature. And that's where it became sort of the no man's land from a regulatory perspective. When we sat with the regulators and worked with MAS here, they said, please build the exchange. We love what you're doing. We look just like an exchange, and at the end of 18 months, they said, great job. We're not going to regulate you. And I was like, what? I'd never met a regulator that didn't want to regulate somebody. And the issue was, in 1994, Singapore had classified carbon credits long before the first one was ever transacted as an intangible asset and put it on a shelf and forgot about it. Yet, drove policy, the green plan, the 4 pillars, everything, and everybody forgot to look at the underlying asset. Now, I'm a commodity guy. The asset is the key. Everything that's built on top of it is all of the market, the generation, the financing, the transactions. So I said, okay, let's back it up. How do I own a carbon credit? And then I realized you can't, it's difficult to own a carbon credit. So we really started from the ground up, working with the registries directly, taking a page out of commodity warehouse structures, not too dissimilar to BACT, what you did for Bitcoin. There's a logic of how you can build a framework for ownership and custody. And then we started to look at the technology. How do you transact it? How do you take the friction out of the market of ownership and transference of a carbon credit? How do you get a clear price signal? And that's all market formation. Fast forward, now I'm unregulated, market formation, 2020, 21, in the middle of COVID, and now we've got a massive environmental awareness, and the market scales on its own. And then we go to COP26, and it comes out a little bit scratching their heads, and now we've come out of COP27, and I think there's more head scratching. The key for me as a market formation is if you're going to get financing into what I consider a commodity, you have to have market frameworks and regulations. And I'm not talking about compliance markets. I'm not talking about ITMOs or CBAMs or corresponding adjustments or defeating double counting and double spending. I'm talking about baseline market formation of a financial instrument. And you as a banker would appreciate this. How do you get it on a balance sheet? How can you hedge it? And so that's why we went to Abu Dhabi. So we were invited actually out there by ADGM and the FSRA to have a discussion around forming a regulated market around voluntary credits. And the idea there was to work directly with the regulator to really change and define the nature of what is a carbon credit. And they wrote a new regulatory framework under a broad stroke called environmental instruments that classified voluntary issued carbon credits as a spot commodity. It's the first regulator in the world to do it. Right? US does not do it, Singapore does not do it, actually nobody does it, but yet you have futures trading on the underlying. So that was key. So now, from a banking perspective, we could invite banks to come in and they could put it on balance sheet for the first time with a full clarity on it's an underlying carbon. Now we can build financial products, fungibility, and all the other parts. It's still early days for us, but then they expanded it into this broad stroke of environmental instruments of what we know today, voluntary credits and allowances, and what's going to be in the future. What are the next legs of development around the instruments for decarbonization? And they said they are fully recognized financial instruments. So that's another step forward. Now, FSRA and Abu Dhabi are not the biggest markets in the world, but they're intrinsically important in their physical and geographical positioning, wealth generation, but also to their IOSCO signatories. So they're associated with 91 other countries through the IOSCO principles. So this is where I see really is the opportunity to, let's dial it back, get logical about how do you put a structure around the product, how do you allow for the financialization of it, allow for it to be on bank balance sheets, hedged properly, trades, transferring, so basically the ability to register, verify, buy, sell, hold, transfer, and retire carbon credits across a whole regulatory framework.
Thank you. So it's quite interesting when I start thinking about what Sandeep was saying about the light touch approach to some regulation, and where we're hearing from you where you've got full-blown legal classification, but one that enables potential financial instruments and money to flow into carbon and treating it as an asset that, as you say, can be reflected on balance sheets and therefore could be invested in a more formal way. Mike, ICE has been a regulated futures exchange for a very long time. Probably you don't even know this, but I wrote your EUA futures contract, your most successful contract back in...
Congratulations.
2006 for my sins. So you've most recently launched an NBS voluntary futures contract. Clearly settling physical contracts like voluntary carbon credits is a different game in one sense than settling EU allowances on a union registry. Can you help us understand the thought process or the diligence process that ICE went through in trying to deal with the obvious issues associated with doing a futures contract that is not cash settled and is a voluntary carbon product nonetheless?
Thank you. Good question. And just to start with some thoughts on the taxonomy of carbon markets. So we all spoke about the difference between compliance and voluntary and what they do. And really we're speaking about the carbon markets, right? So allowances, which is a cap and trade system, they value the negative externality. Belinda mentioned the permit to pollute, where carbon credits are, they value the positive externality of putting value on natural capital, right? So whether that's removals, reductions, tech, or nature-based. So, you know, really as we walk through this path together, it's important when you think of, you know, I don't know how many people in this room here were in the last panel, but there's a really great slide on corporate commitments and how that's increased. And the next slide was on retirements. And while it's gone up, really there's what's the penalty for making a commitment and not fulfilling it? There's nothing, right? I mean, you could say there's some social backlash, but you can't say you pay. We're in a compliance market, in a mandated market. If you don't submit an EUA for compliance, you're paying 2 or 3x. Plus, you got to go find the physical and then retire it. So there's difference there in that if you make a commitment, that should become a liability on the balance sheet, and you should have to be held accountable, whether it's to, unfortunately now on the voluntary side, it's not to a regulator, but at least it should be to your stakeholders. So that's interesting. And you know, I'll give you two examples, Peter. So on the nature-based side, the carbon credit side, creating that contract, as you mentioned, we have a suite of 11 products, Vera delivered, physically delivered, you know, a Fulu, CCB, and then we're launching the Washington State Cap and Invest program, which is very similar to California and Quebec in North America, but one is regulated, one is not. For Washington, there's the legislation and the regulation. You can just pick parts out of that regulation and put it into the contract. The registry, kits, what is a metric ton of CO2, the contract size, it's physically delivered, what covered entities from the buy side are mandated to buy these and then retire them to the regulator, where on the carbon credit side, it's completely different. You have to ask people, okay, well, which registries are standard should we use? Should we use all of them? So then it's seller's choice to deliver to all 4 or 5 or whatever number of registries there are. Then you have to make the buy side then get an account in all of those. So you know you have to pick and choose, and then again, whether it's tech or nature-based. So really, when you think of the long-term goal as an exchange, again, for California, Europe, UK, or Washington, which is the most recent example, is it's just a plug and play, where we're on the voluntary side, or the carbon credits side, excuse me, it's much more difficult to do. And then, of course, for the physical delivery settlement of it, there's intermediated, where the clearinghouse where the seller will send to the exchange, or the clearinghouse, excuse me, in the registry, and then we turn around and send that to the buyer for complete anonymity. Or there's bilateral, where the clearinghouse will match the buyer and seller, and then there's name give up in delivery. So there's nuance there. Various physically settled products around the world all have different methods of physical delivery, and it's been a pain point for customers.
So regulation makes the type of product development that you're looking at easier. It simplifies some of the choices that you're otherwise forced to make. And picking up on Tom's point, it allows more liquidity and investability to flow, therefore presumably into the contract in question.
Absolutely. So there's the fungibility is one thing, but if you know you're going to get physically delivered only one thing, a California carbon allowance or a European, an EUA, that's all you're getting, right? There's no, it's not cheapest to deliver. Nature could be any vintage, so there's some very specific nuance in there, which the regulated markets really help to take that pain away. So that's where being a proponent of that regulation. Now look, is there going to be a global cap and trade system? Probably not, right? So how do we bridge that where you do have cap and trade programs around the world that, whether they trade as futures or bilaterally, that the widget that you're trading is the same within that program, where the carbon credit space, tech removals, nature-based, there's all sorts of different types of physically delivered commodity.
So something Sandeep said and something you're saying is now beginning to correlate, which is, if the voluntary market is too fragmented, too complex, there are too many different versions of credits out there, it's difficult because it's hard and it's not easy to explain. And therefore it's not easy to build products around, it's not easy to build liquidity around. So actually, overall, we're not doing a very good job by creating too many different classes or types of units. Right? Okay, good. Now, Professor Liang, I'm going to read a definition from an article. It may or may not be the actual definition of what a greenwashing claim is, but it reads as follows. Greenwashing claims are essentially exaggerated, misleading, or unsubstantiated claims that mislead investors into investing in products, financial instruments, shares, etc. So we've been talking about the regulation of the market in general without being too specific about who we regulate. But one of the reasons why you hear a lot of noise in the market about regulation is also because people are concerned about greenwashing claims. Now, interestingly enough, in the way I think of the problem, greenwashing claims are an accusation placed at the voluntary corporate net zero buyer of the market. So if you will, it's the demand side, not the supply side. So when you get to the point where the greenwashing accusation is pointed in that direction, and the question arises, should corporates' claims themselves be regulated in any shape, form, or manner in order to avoid greenwashing? Do you think that is the right way to look at the issue? Is there an alternative? And I ask the question about the alternative because we have other initiatives in the market. For example, the VCMI has been looking at the buyer claim end on a voluntary approach, which is not fully legally regulated by a formal regulator. And you have the supply side being looked at by an organization such as the ICVCM, which is looking at the integrity and quality questions associated with carbon credits. So bearing all these factors in mind, what's your view?
Okay, thanks, Peter. Before talking about greenwashing and where the regulators play a role here, I want to draw an analogy between carbon credit or carbon trading market and stock market. I'm a financial economist by training. And when we think about stock market, first we need information. We need disclosure from companies. So we do need regulations. And the question is where the regulators should stand. Should the regulators heavily intervene with the market, or should regulators only set up the standards and who should be accountable when there is a lawsuit and when there is a misguiding information? Not using the greenwashing word, but a similar analogy, then who should take the responsibility? Or you can have an alternative approach, which is just keep the market unregulated. So you have three versions, right? Heavily regulated, lightly regulated in terms of only setting up rules and accountability, and no regulation. And there are abundance of empirical evidence basically saying the second type is probably what we want. So we do need regulators because, from the incentive perspectives, corporations do have an incentive to sometimes misreport their key information. And so you need to keep someone accountable, and you need to tell people what is considered as misreporting, misdisclosure, and what is not, and what situation you should have this person being accountable for the misreporting. So coming back to greenwashing, okay? So if you think about carbon trading markets and connect it to the stock market, you also have the price being a reflection of some fundamentals, right? Stock price is a reflection of firm level cash flows, whereas carbon price is a reflection of how much the firm needs to emit from its production, and at a macro level, the economic growth. So in this regard, the carbon price plays a signaling role, and how much we can trust the price depends on how much the firms disclose their carbon emission or more broadly ESG information. So if we need some light touch approach by the regulators, then I would say similar to what we do with the stock market, we regulate who are accountable, who hold liabilities, what are the standards out there that companies or suppliers of carbon offset they should follow, and then let the market run. Okay, so I think this is again, I'm an academic, so whenever I make a claim, I try to back up with the numbers. And of course, the sort of the conclusion I draw, and we call it private enforcement vis-a-vis the public enforcement, where you have this very strong regulator that heavily control the markets. Private enforcement is the regulator set up rules and then let the market play. So there's abundance of quantitative research, data-driven evidence showing that this private enforcement fosters the market the best. So I think this is where we are going in terms of alleviating greenwashing concern, making the market more functional. So you have, EU taxonomy, you have, SFDR, CSRD, and I think EU is leading the way in this regard. So they do set up standards, and I think that's what they need to do. Not beyond the standard setup, but make the standard clear, and then companies disclose based on the standard setup.
I'm going to follow up there because you said something that I think was worth clarifying. So you have companies who are listed on the stock exchange. You have very, very large companies who have who are regulated by existing governments, and then you have private companies who are unregulated and therefore don't have the same sort of market exposure to shareholders, and therefore there are not shareholders who need to be protected by them, right? So do you draw a line in to whom this disclosure regulation should then apply, or do you think it should apply to everybody, come what may?
Yeah, so I think different jurisdictions adopt different approach. For example, large economies, you use carbon trading, whereas Singapore mostly focus on carbon tax, which apply to both listed companies and private companies. I mean, again, coming back to stock market or equity investments, so you have private companies which are not listed, but they still have a price. So maybe venture capital, private equity investors, they, based on their analysis, they do, cash flow discounted modeling approach, and they come up with, a price for, those unlisted companies. And there's pre-money valuation, post-money valuation. So I think if we follow the same logic, there should also be a price for companies not being listed or for carbon offsets not being treated. But we have other means, right? So carbon tax that I mentioned earlier is one mean. There are other, sort of private market in the carbon trading system. Even you don't join this ETS, but then on the other hand, you do transact with other parties, and there is a price, there is a value for the transaction, which can be used as a benchmark.
Thank you. We've got about 17 minutes left of the session, and I want to make sure that there is time for audience questions. But I've got a few questions by way of follow-up to my panelists here. So I'm going to start with an open question, and I'm going to look for a volunteer who wants to answer this one. So just picking up on the theme of who should be regulated, is it the producer of the carbon credit, or is it the end user of the carbon credit in the voluntary context? That's the area I'm focusing on. So there's an open letter published by a number of US senators instructing the CFTC, this happened sometime in the last 6 weeks, saying that there's a whole raft of greenwashing concerns they have. They named a couple of banks who've been using dodgy carbon credits, as they described, towards meeting some sort of claim, and they're instructing the CFTC to look into the regulation of the suppliers of this carbon credit, right? So in other words, those senators are saying the people that should be targeted for regulation should be the Veras and gold standards of this world. So let me now throw the question out there. Who thinks that is a sensible approach, and why?
I'm happy to respond a bit to that.
Thank you, Belinda.
Okay, it's been very interesting to listen to the different perspectives. There were a couple of things I think I'd like to comment on. First of all, the financial instrument versus commodity. it is an either or, I think, because a financial instrument is what it says. It's an instrument for transferring finance, for transferring money. That is not what these are, right? They are an instrument for transferring the reduction or removal of carbon in the market. And the issue of greenwashing is, as mentioned, it's an issue of misrepresentation. And parties on the buy side want to simply be sure that what they're buying has integrity, that the claim that they are making, that they have offset or funded the reduction or removal is true, that there is a real ton of carbon that has been removed. Now, you have to go back to the science there. You have to look at the science base and work out whether the baseline is correct and the measurable and verification of that carbon unit is correct. And to do that, you have to have accredited standards. Now, I would liken this very much to the commodities market. You can go and buy aluminium, you can go and buy gold, you can go and buy a number of different commodities anywhere you like. But if you want to be certain of the quality of it, you go to effectively an accredited market, like the LME or the LBMA, the London Bullion Market Association, or you go to an accredited ags market. So I think that we have to be very careful and separate out all the different parts of the chain here. The first thing we have to sort out is the production, the accreditation of that production and the standards to which we want those to be produced. Then we have to then look at really what we're saying here again is the voluntary market. Now, quite right, there are some compliance markets which will accept or want to accept project-based carbon reductions. And what they should be saying is, I will accept these certain brands, these certain types. That's a bit like saying, I want a particular type of aluminium shape, right? I want ingots, or I want T-bars, or I want a particular bar shape and a particular purity of gold. So that's about the sort of what is eligible for use within certain markets. When we're looking at the voluntary market, the purchaser simply wants to know that a ton has been removed. It is then up to them on a pricing value, really, whether they want to invest in tech removal or nature-based removal. And so I think it's a labeling issue and an accreditation of the production that we've got to start with. And it's very easy to get very confused because we're talking about the production, we're talking about participants, and we're talking about claims at the other end. And I think we need to segment all of those out. And there will be, oversight will be different according to the use of the item.
Thank you, Belinda. Thank you. That's a very helpful clarification. I'm going to ask Sandeep, because A, he's itching to say something, but also I've got a more fundamental follow-up from Belinda's point. You know, there is a problem in saying that the carbon credit is good by an accredited organization, and then NGOs in the market saying, yeah, notwithstanding what they say, I still don't think it's good enough, right? So you get to the point where you start thinking, well, I have a RED Plus credit, what's wrong with that? And somebody says, yes, but it's not a removal credit. So how do you deal with this never-ending filtering of what is considered good quality? Where does it end?
Yeah, I mean, exactly what I was itching to say, actually. I mean, when you say a dodgy credit, that's on the standard in a way, because the buck has to stop with the standard and not with the project developer, because I have to trust something in the markets. If I have been issued a credit, as far as I am concerned, this credit has gone through the due checks. Now, what we are trying to do here is, and I think, you know, look, the bigger participants have been Vera and Gold Standard in terms of issuances. And there are some, of course, North America as well. We have to start trusting the standard, or working with the standards to make sure they can be trusted. As a developer, I can't be answering to the standard and then to somebody else who says, no, but your baseline isn't right. So then who am I working for really over here? So that's really important. If you want to build trust in the market, I think we need to first start trusting the standards. Because we can't have oversight over oversight. Then we're just going down a black hole. So my only point is, look, on the regulation side, as has been made very clear in this session, there are different market participants. There's me who makes the credit happen via a standard. Then there's an intermediary or a trader who then trades it to an end buyer. So there are 3 different regulation points here. You know, where ICVCM looks at the supply side, I represent an organization called ICRO, which looks at the intermediary side and how they deal with the markets. And then you have the end buyer side, where you will need regulation on the asset class classification, commodity, et cetera, et cetera. Another point to be made is not everything in the market can be standardized. I know there's been a big push on standardization, but if you look at my projects, they're not the same at all. And I can't have standardized pricing for it, nor can, you know, because NBS is not the same everywhere. While Red Plus can be standardized to some extent, removable projects, forget about it. You will get something at $6 a ton, you'll get something at $60 a ton as well. There's no way you're going to standardize that. So my thing is, yes, we get thrown a lot of that scale, but in my opinion, the buy side is trying to move away from the sell side, saying, okay, do we have confidence in this exchange? Let's just go and buy. That not necessarily is the way this will pan out. Futures exchanges, a big thing that still hasn't been seen is going to be under delivery. NBS is going to under-deliver in certain instances, and this we see as a problem coming up on future markets. Red, not so much. So these are things that we need to understand as well, because on the supply side, there are challenges here. Commoditization of renewable energy, energy efficiency, industrial efficiency, go for it. But on the NBS side, we need to be a little careful. And greenwashing, last point, it's almost better for a company to not do anything than to do something today. And that's a problem, because we are actually going after companies for doing something. Companies will just stop doing anything, because they're like, this is not worth our time. Because the moment we do something that somebody says, no, this is not the right thing to do, well, that's voluntary. We have to give them the benefit of doubt over there. So I'll stop there. Thanks.
Thank you. And a nice segue to a term that I wanted to bring up at some point today, which was greenwashing, which is, of course, a term I only learned in the last 30 days. So greenwashing is essentially the problem Sandeep was alluding to, where companies just don't want to publicly state what they are doing. They may do things quietly and privately, but they're so scared of being criticized for their efforts that they actually don't want to be transparent about it. And everybody who wants to build a market will say to you transparency is important, because that way we have a clear vision about what is the real supply and, of course, what is the real demand. So how does one get the balance right? And I'm thinking maybe Tom and Mike, you can chip in here. Clearly, from what we've heard so far, there is a need for some sort of regulation at some point, but it needs to be of the right balance, not too heavy, not too light, but it needs to be something that nonetheless supports financial markets and investment. So that's the big challenge, but how do you get the balance right?
I guess, again, I've been in business a long time, and markets don't form overnight. And market adoption, and Mike would know this, I mean, we take for granted what are the benchmarks today, whether it's an S&P 500 or a Brent crude or power, markets, the price of electricity in northeastern United States, there's a price. It took years to form those pricing benchmarks. We're in the world of instant gratification, especially with the electronification of markets and the digitalization. We think instantly, oh, there's a number, let's everybody use it. Everybody forgets there's a whole lot of work that goes on behind it, and that's the carbon market today. The carbon market is, even though it's almost 20 years old, it's in its second iteration. The first time it worked, and then it didn't. And now we're in a phase that we really can't fail at this time. So, but I'm absolutely amazed at the number of critics that have arisen in the last 36 months. And people, it's shocking, actually. I can understand from the science, somebody might be a critic from science or the academics, because they're looking at the minutiae. But the market players, the people have come in and said, oh man, that's a bad carbon credit. I'd be honest with you, the first thing I asked them was, so what was your job title last year before you became the CSO? And it'll stop most people in the track, because it's not their background, it's that new opportunity. And we've seen this in the financial worlds. I can tell you, if you go back 20 years and the collapse of Enron in the United States, and I mean, this is the rise of ICE, the world went, oh my God, I can't trade with that guy because my intermediary has disappeared. What's the new market gonna look like? But then it was like the accounting systems went, hey, let's invent Sarbanes-Oxley. And suddenly we had tens of thousands of people that were Sarbanes-Oxley experts, and that came and went. And then after Lehman Brothers failed, and we suddenly had a massive amount of people that were suddenly Dodd-Frank experts and AMIR experts and everything against regulation. We've suddenly got, hey, carbon's really cool. We've suddenly got a lot of carbon and sustainability experts. Forget the noise. The reality is this market is going to form. There's demand. There's a willingness. There's an opportunity to financialize it. There's an opportunity to create benchmarks. And if you look at, I'll just use one last example. Back in 1983, a long time ago, there was no benchmark price for crude oil in the world. Yet there were 167 crudes that were being traded around the world, all in their own way, very opaque and long-term contracts and everything. And people realized, especially post the oil crises in the 70s, we needed a price. So two prices really formed up. But there were actually like 7 different prices, and then ultimately Brent for Europe and WTI for the United States formed up. And now we've got Middle Eastern crudes. The market adoption there was, are those the defining crude prices? No, those are the benchmarks, and then everything else gets priced around it. So this is going to be the carbon benchmark formation, right? It's going to be, what's the price for nature-based? And maybe that price forms up on ice. Everybody's going to go, but I got nature in the Amazon. Oh, that's plus $1. Or I've got, you know, that, I mean, that's, and I know I probably talked too long, but the reality is the markets will form. They're not going to form overnight. And there's going to be a lot of pain points and a lot of experts, and people will come and go, and trust me, maybe next year there's something new, and those people will move on, and they can go criticize a new industry and leave us alone and let the market form. And so,
Mike, he's suggesting patience. We know we don't have enough time. We wasted 10 years between Kyoto and Paris, so what do we do?
I'll just say 2 quick points that piggyback off of Tom. If you speak to a potential customer on these markets, and you know a guy that's been around, girl that's been around for a long time, they're like, oh, this is the oil market in the 80s. You mentioned that. Oh, this is the natural gas market in the 90s, prior to Henry, prior to TTF, prior to Brent, prior to TI. And the second thing I'd say is, excuse me, I was having a conversation last night. It's like, well, just spread everything. Look at the oil market. It's a spread to everything, but it's a spread to the most liquid benchmark that exists, which is Brent or TI. Everything's a spread, but what would we spread a removal or there's just, it's not there yet, so it's forming. So you know, we have these conversations all the time at the exchange, but you know, is this product ready to be futurized yet? And you know, do you want to be first? Do you want to be a participant? Do you want to be an observer? Will it be too late? So you know, the nature-based solution, to call it a benchmark is probably a little premature, but it's just such a from the supply side. It's favorable. I know we're running out of time. I just wanted to make that was a really good point. You know, I think I would echo that really you need that benchmark, and it's going to take time.
Thank you. Can I see if there's any questions from the audience? I see one hand over there on the back. We probably only have time for maybe 1 or 2, so there's a mic coming to you. Could you introduce yourself and your question briefly, please?
Thank you. My name is Amit Tusu. I am from Global Carbon Council. But I'm not talking as a Global Carbon Council right now. I'm talking as someone who has worked with the CDM Executive Board. I was with UNFCCC. I know what goes on in and on. I worked as a verifier on ground. So I think there is a question about the quality of credits. Whose is the responsibility? Is it standard? It will be verifier. So I think this happened with the CDM. There was a lot of criticism on CDM, that the quality is not good, so what needs to be done? We had a meeting with the verifiers at that point in time, with the CDM Executive Board. So this UNFC's response was that verifiers go on the ground, so they are responsible. They see what is happening on the ground, so they know the facts. Whereas the verifiers are not that big companies, you know, they can't take the huge liability on everything that happens. And quite a number of times when the verifier goes on the ground, everything is cleaned up. So the project developer is also involved in this whole thing. They know what's going on. And to have 100% certainty, the integrity of credits is, in my understanding, a task which is quite extremely difficult. So I think it's a joint responsibility in my understanding. There has to be certain quality standards of the project developers. There has to be codes of conduct that need to be followed. It's everybody's responsibility. Thank you.
I think that was a statement rather than a question, but we only have 40 seconds left, and I am keeping the audience from lunch, so I am very conscious about that. So I'm very sorry about that. But Sandeep, we've got 30 seconds. Do you want to just respond to that comment?
Yeah, I mean, look, I agree that there are so-called bad actors, but then one or two bad actors does not mean the entire. You don't throw the, what do you call it, the bucket,
baby out with the bathwater.
Yeah. So I think the buck has to stop somewhere, and for me, this is with the standard. Again, we may disagree, Amit, on that because but again, if we go down that road, now we'll have to then evaluate every damn project, every verify who went on ground, and then where does it start, where does it end? So we have to, the buck has to stop with the standard. Yes, project developers are in cahoots at times, I agree. But then that's something that we will have to work harder to make sure that does not happen again and again. Make stringent more, I mean, make the frameworks more stringent. But the buck has to stop somewhere. We can't be calling dodgy credit. What is a dodgy credit? If it is an accredited organization has credited, period, it's a credit. And that's how we should be looking at it. Thanks.
Thank you. Belinda, I don't know what time it is for you right now, but I imagine it's not a very friendly hour. My special thanks for you for joining us all the way from wherever you are. I wish you could have been here. Can I ask the audience to show a round of appreciation for my panelists? And thank you for staying for as long as you have.